Hey everyone, thank you for joining this week's Tea and Crumpets. I'm Gloria S, Crump, the Queen of Real Estate, and I own the Coastal Leaders Realty Group. And I'm here today with Jennifer Strickland with Assurance Financial, and she is going to tell us why rates should not scare buyers off. So thank you for joining today. And yes, definitely. So obviously with the interest rates increasing, I know you hear it because I hear it, and you're in the mortgage business. And so when you do hear buyers saying, you know, they're hesitant to purchase right now because of the interest rates increasing, how do you respond to that? What's your advice to those buyers?
Absolutely. Yes, it's a very common question, and it's a great question, right? So because I'm a numbers girl and you have to know what the numbers look like. So whenever somebody's talking about, you know, if they are in the market to buy a house, you know, for whatever reason, this is the year they want to buy a house, and they're worried about rates. So here's how it is. And there are lots of different industry evaluations that are out there as far as appreciation estimates, right? Yeah. One of them that I read that came out recently, year to date, it's been a little over 4%. Year to date, but by the end of the year, they're estimating it to be a little over 6% appreciation. It also said in that same report that from June of 2023 until June of 2024, they're estimating that average appreciation to be like 10%.
Okay.
And I start by giving clients those numbers just so they know I use a 5% appreciation. Yeah. So I give those higher numbers to know when I say 5%, that's still being conservative.
Yeah, it is.
So let's just use something kind of middle in the road. I know in this market there are higher values, there are some places with lower. So let's say if we're looking at a $300,000 house. So a 5% appreciation on a $300,000 house is going to be $15,000.
So it'll be $315,000 this time next year, so to speak. Yeah.
Correct. So, but it won't cost $15,000 to refinance.
No.
So if they're looking to buy a house now, they can make sure they get the house that they want. Then next year, if they are estimating that, you know, values, rates are going to be going down, you know, it could go down 1% or more, we're hoping, but still with that conservative 5% appreciation, the house value will pay for their refinance. Then they'll get to skip a month's payment.
Well, that's nice.
And then a couple weeks after closing, if they have money left in their escrow, they're also going to get a check in the mail. At that point, I like to say, stop me when something sounds bad.
Yeah.
So the flip side is, you do wait, then maybe the house that they really wanted isn't going to be available.
Exactly.
Then they're paying that seller the full cost of that appreciation. And again, they may not get the house that they want. So understandably, it still has to be a payment that they're comfortable with. We have lots of different programs and options, so I can always get them in something that works.
Well, I think that it does help people to probably then start dissecting the whole scenario instead of looking at it and be like, oh my gosh, I'm scared, you know, let's just wait, when they can look at it and then dissect it into what their price range is and realize, wow, I might as well go ahead and purchase, especially when they come across something that they want, and then they refinance later.
Correct. Every time I'm working with a client, no matter what they're doing, I always make sure that they have a mortgage plan, because a mortgage in a house is part of their big financial picture, right?
Yeah.
So it's not just we're closing on that purchase, it's okay, now that you have this house, you're getting this house, here's what I see for you as far as the next steps of how to maximize this, not only as providing for yourself or your family, but how this fits into your big financial picture.
Exactly. So obviously down here we have a lot of cash investors coming from all over, you know.
Unfortunately, I haven't found myself related to any, but I'm still looking.
I always ask to be adopted, but you see that hasn't happened either. But you know, hey, but at least they're using me to look. So when we're dealing with cash investors and, you know, they feel that, you know, what advice do you have for them to maybe not use all their cash, and because, you know, they feel that, oh, well, we might get a better deal because of if we do cash and not a loan, but there's advantages of getting a loan, which, you know, so
yes,
what is your advice for those buyers?
Gotcha. So yeah, and part of my background is I did spend many years where I was security licensed, and I also did investments for people, and I set up 401ks as part of that. So I do have, again, that brain that I'm looking at the big picture. So whether it's you know, an individual buying a primary residence and maybe they have equity out of a house that they want to move over into a new purchase, if it's an investor looking to pay cash, I always tell them, take a minute, do you have a financial advisor, financial planner, have a conversation with them about what that cash could be doing if you didn't put all of it into your house. Because the nasty word that's floating around right now, cash in a house is losing value because of inflation while that home is increasing in value. And I'm not saying it's an all or none. If somebody wants to pay cash for a property, I'm not saying, well, don't pay cash, get a mortgage for the full thing, but definitely have a conversation with a financial planner, financial advisor, and just find out, what would it look like if I took part of that money and invested it? Or would it be a better situation for a home buyer to say, should I get rid of all this non-deductible debt that I'm not getting any benefit from and have this mortgage? That's been a huge thing right now.
Yeah. Well, just because, for instance, if people do have debt, a lot of times with like credit card fees, I mean, they're 20%, maybe even plus, and then your interest is typically, if it's an investor, you might be a little north of 8%. If it's, not a second home. If it's a second home, it's usually a little bit north of 8% if it's an investment. But I mean, I think that's
absolutely
correct. Okay, good. Because I was about to say, I looked the other day, and so and you can do a write-off, for the interest. So if you don't have enough to write off, I know everybody.
And with the interest rates, and of course the interest rate, if it's making that mortgage payment higher, more than ever, working with people to say, like, I had a client, actual scenario, put $25,000 less on their house. Their house payment went up by $100, but with that $25,000, they got rid of $600 in monthly payments. So now they still have that positive cash flow of $500. So if the interest rate is making that house higher, there are different things that we look at to make sure they're maximizing that big picture.
Yes. Well, I think that really does help, and I think it might, broaden some people's horizons when they're thinking about purchasing, if it be a primary or, a second home investment. And I think that I really do appreciate you coming and talking. We're going to have her contact information at the end of the video, so that way you can talk to her and ask questions, and I highly recommend her when you're in the market looking. And so, thank you.
Thank you so much. And I will say, I'm a full-on loan nerd. I love what I do. You can ask me all the questions you've got. I love that. So,
yes,
and thank you so much.
Thank you. Well, we hope you enjoyed it, and we look forward to seeing you next week.